Hey, Bowtie Nation. Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Stocks to watch, economic news to highlight. Stocks did resume their pullback last week, and investors are worried about that historically bad September October period for the stock market. In times like these, I find it helps to do that kind of long term analysis that confirms why I bought the stocks in the first place and why I should hold on even through these tough markets. After looking at today's analysis on Amazon, you're going to forget all about that near term weakness. And if you don't already own the stock, well, you're going to see because two methods of valuation put Amazon at a $3 trillion company or about a $300 stock price over the next couple of years. That is a 100% plus return. Stick around after that. We'll do our stock market update with the stocks I'm watching this week, as well as the economic trends you need to see. First, though, today's sponsor makes building your credit score easy. That's because the Current app is both a banking and a credit app all in one. Every time you use your Current bill card, that debit card linked to your account, you're building your credit history. That's because each purchase is reflected on your credit report, rather than some other credit building strategies that push you into debt. This one uses your own purchases rather than debt to build up your credit. I know we don't talk much about the credit score here on the channel, but the importance came rushing back to my family just last month when we were closing on our new home. A higher credit score means a lower interest rate, and with every 1% increase in rates adding tens of thousands of dollars to the cost of even a $400,000 home, you cannot afford to ignore your score. So look for the link in the description below to learn more about Current. You're going to be able to create an account with no credit check and no credit history needed. There's no minimum and no monthly fees for using the Current Build Card. You're going to earn up to $240 a year with the 4% interest on your savings. Back to our Amazon stock analysis, though, because Amazon's shares have always been kind of my white whale, right? The one that got away. It went IPO and offered shares just after I started investing in the Marine Corps. I wasn't much of a tech investor then, not wanting to bet my hard earned $800 a month corporal's pay on the risky tech stocks. Even when I started getting more into the analysis and as a professional analyst, Amazon always seemed too expensive. We see price valuations on Morningstar, and as recently as 2015, the stock still traded for a price over 1,000 times its earnings. That's when 20 times PE ratio is considered expensive. Investors were paying 1,000 times PE for Amazon. Of course, the shares went on to produce a 573% return to that pandemic peak just over those 5 years and made other investors very rich. I did finally start investing last year when the shares hit $94 each, even though that was still more than 60 times on a price to earnings basis. Shares of Amazon are now at $138 each, about a 47% return on my position, and deep analysis of the business segments separately leads me to believe we could see another 110% return just in a very short period. Nation, Amazon will be at least a $3 trillion company. First, I'm going to highlight some recent news, some short term catalysts for upside in shares of Amazon. We'll spend more of our time, though, in a piece by piece valuation of each business segment. That's the cloud, e commerce, logistics, and advertising, and why I think shares of Amazon are clearly worth more than they're in the market right now. First, here in the next month, we do see Amazon's third quarter earnings scheduled for October 25th. The street is expecting 58 cents a share, which would be a huge improvement over the loss in last year's quarter. The company beat expectations last quarter by 85%, reporting 65 cents per share earnings on expectations for just 35 cents a share. So clearly, earnings have found some kind of a rebound momentum. That would be on expectations of $141 billion in revenue, up 11% from last year's $127 billion in the same quarter. And just after that, we do have the AWS reInvent conference scheduled for November 27th. If Amazon doesn't say much about AI during its earnings release, it might be saving it just for this. So I would be buying any stock dips here in October in that third quarter report. At the November event, the company is expected to unveil new AI capabilities and services in its Amazon Cloud Services, that AWS, a move that could broaden its lead in a very profitable cloud segment. One of the most interesting news, and really a sign of the dominance that Amazon has online. The company also recently announced a native app integration with Shopify, allowing merchants to buy with Prime on their Shopify stores. Now, this simplifies the merchant experience, syncs orders, promotions, and taxes across the sites. For consumers, Prime members are going to get access to that faster delivery and free returns on Shopify. Morgan Stanley estimates that for every 10% penetration into Shop's U.S. gross merchandise value, that GMV for Amazon, adds $800 million to Amazon earnings. Okay, it's just another way that Amazon is leveraging that scale and size of the logistics network outside of its own main platform. And think about this. This is why this was so interesting to me. One of Amazon's biggest competitors, or was supposed to be one of biggest competitors, Shopify, supposed to be a huge Amazon alternative, it's pretty much concluded that if you can't beat Amazon, you might as well join it. All of these headlines are supportive of Amazon's share price, but it's this deeper valuation I want to go into that had me buying more shares. Let's look at the valuation of each business segment for that sum of parts analysis, then just a simple price multiple analysis to see how high Amazon could go. Over the last couple of years, Amazon Cloud Services, that AWS, has become the company's growth engine with 32% of that fast growing cloud services market. This was followed well behind with Microsoft's 23% and Google's 10% of that cloud market. The segment booked $22.1 billion revenue in the last quarter. Here we see the second quarter earnings report. It's about 16.5% of total sales, but this is growing much faster than those other segments. Now, here in a research by Morgan Stanley, we do see that AWS growth is cyclical around its optimizations, really phases that it goes through to make that cloud services more optimized and better, a better service for customers, with growth down from about 32% year over year in 2022, down pretty heavily this year, but it is expected to start that new upswing, reaching up to 20% sales growth and higher by the end of the year. And I think even that could be underestimating growth potential here if we get some kind of AI integration into AWS that could drive higher growth over the next couple of years. Just on that growth potential, though, AWS revenue should reach about $140 billion over the next 3 years. And we've already seen analysis that this segment alone is worth more than the entire company's current valuation. Third Point LLC founder Dan Loeb made headlines last year saying the company was undervalued by at least $1 trillion. This was when Amazon was trading for a market cap of $1.55 trillion and had 477 billion in annual sales. Since then, it's grown revenue by 12% to $537 billion and is still a $1.4 trillion market cap. So the market cap came down slightly, grew by 12% on sales. Loeb's hedge fund owns $784 million in Amazon stock, says the AWS segment could be worth $1.5 trillion alone, with the e-commerce business worth another trillion. We're going to break down these other segments, but I think that $1.5 trillion AWS segment valuation probably a little low, but we're going to use that for conservative estimates. You're going to see how high this can go just with even the very base conservative estimates for Amazon. Now, that e-commerce side of the business, so the main platform is slowing, but it still dominates online retail sales with 37% of the US e-commerce market. Not even second place Walmart is even close with 6.3% market share. Slowing retail sales on a weakening consumer have slowed overall retail growth to about 3.9% this year, according to eMarketer, but e-commerce growth is still growing at almost a 9% pace each year. Not only do we have that faster e-commerce growth, but online retail sales are still just 16.4% of total sales, total retail sales, leaving a lot of room for growth. And with that 37% market share dominance, Amazon is going to be there to take the lion's share of this future growth. Back in the second quarter results, we see Amazon platform, including its third-party seller business, it's roughly about 67% of total revenue. So about two-thirds of total revenue. It's about $90 billion in the second quarter and about $369 billion in sales over the last year. So growing at that relatively slow e-commerce pace of about 8% a year, that takes the segment to $464 billion in sales over the next 3 years. Retail companies, other online or otherwise, don't get much of a valuation boost on their sales, but I think this market juggernaut, the dominance of first place position, 37% of the online retail sales market, should get at least two and a half times price to sales valuation. So I'm going to value this at just 2 times price to sales, $930 billion just for the e-commerce segment. Now, the subscriptions and other businesses also growing at a good pace here. 14% a year growth on the subscription business, 26% growth a year on the company's other segments, but both together are still only about $11.2 billion in quarterly revenue. It's about $42.5 billion annually. On a 13% growth rate, we get to $61.3 billion in annual revenue over the next 3 years, adding roughly about $300 billion to the valuation. The big surprise lately, Amazon's advertising business is becoming the surprise catalyst. It's just started breaking out ad revenue in 2021, really showing us the growth in this segment and already reporting $33.3 billion annually. The segment is growing at 22% a year, is already 8% of total sales. Now, folks, advertising is all about data, okay? Better customer data and tracking means better targeting for ads and more efficient ad placement. And Amazon has mountains of this tracking data. It's going to be able to bring those advertising dollars in where Google really dominates in that search and the ad market. Amazon is going to be able to bring in more ad dollars, growing this very quickly, and use it across Prime Video, its physical stores, Alexa, even in the gaming streamer Twitch. Now, I'm going to use very conservative estimates here because the growth in this thing could take it much further, but the segment could top $65 billion in by 2026 revenue. That would still be just the beginning. That kind of growth is worth at least another $650 billion on the stock's market cap. One of the hardest parts about finding a fair value for shares of Amazon is that nobody really talks about the potential for Amazon's logistics network. Okay, it doesn't break this apart in revenue or sales or anything because it's really used as an enabler for the e-commerce segment. But as a standalone business, this would rival any of the traditional carriers like UPS or FedEx. That means we really can't do a valuation without data here, but we are already at $3.38 trillion with these other segments. That is a $1.5 trillion evaluation from the AWS cloud segment, $930 billion on that e-commerce segment, $300 billion on subscriptions and the others, and then $650 billion from that ad segment. That is a valuation of $3.38 trillion within 3 years and would be Amazon at $327 a share. Back here on the Morningstar historical valuations, and right now the stock is trading for about 2.6 times revenue. That alone is a 26% discount to the 5-year average. We see the 5-year average price to sales valuation here at 3.5 times sales. The PE ratio is kind of out of whack here because last year's expenses were really high, driving those negative earnings. So it blew the price to earnings out of whack. But the shares are trading at 67 times the full year 2023 expected earnings. Okay, 67 times price to earnings on 2023's earnings. That is a 32% discount to the 5-year average, or right around 99 times on that PE basis. So buying the shares now, you're getting a discount of 26 to 32% off of those long-term historical averages. Earnings are expected to grow 15% annually to $6.02 over the next 3 years. I think those could go much higher on the AI opportunities as well as the growth in advertising. Revenue is expected at 12% annual pace over the period to $800 billion. And again, I think it goes much higher. But then, just on these conservative estimates and historic average valuation multiples of 3.5 times for price to sales and about 80 times earnings, we get a 2026 price target between $271. That would be on the 3.5 times price to sales, and then $481 per share on that 80 times earnings. Okay, so between $271 to $481 per share by 2026, even at a 65 times PE ratio, which it would be a decade low valuation. That would be a $391 stock price. Any way you slice it here, folks, between sum of parts valuation, where we found a $3.38 trillion company, or these price multiple valuations, any way you look at this, Amazon is going to double over the next 3 years. That's a 25% annualized return to $300 or more per share. But before you rush out to buy more shares of Amazon, I want to get to our stock market update. The stocks I'm watching this week. First up, AMC Entertainment, ticker AMC, coming off a brutal week, falling 45% after announcing it would issue 40 million new shares. This is one of the catalysts I've been talking about that we thought that would hit the shares, but that could be the low point for the stock. It could have very good 2 months over the next couple of months. I highlighted that in a video this last week where I said I bought $39,000 in the shares. You want to check that out for those catalysts. And a hint is just do not bet against Taylor Swift. Next up here is Apple, ticker AAPL. It's going to start its Wanderlust event on Tuesday with expectations for really marginal upgrades in the iPad Pro and the Watch, as well as some of the iPhone series. There isn't a lot of buzz around that iPhone 15 release, though, and a failure to wow customers with new upgrades might weigh on the stock. The shares are down about 6% since I highlighted this problem the week before last, and any surprise announcement would be supportive of the stock. So I'm going to go neutral on these shares for now. I'm not betting against it because that 6% discount is still pretty healthy, but I might consider buying shares if that dips. If I believe next year, because I do believe next year and 2025 is going to see better upgrades on its products, especially that iPhone going to bring in those customers to recycle their iPhones, and it could be a much better 2024 and 2025 for Apple. I also want to cover shares of CareCloud Inc. here, ticker CCLD. Shares have plunged since highlighting this health IT company in April. I'm picking up more shares to average down on my costs, even on lower sales expected this year. And we can go to the analysis tab here in Yahoo Finance to kind of see where that's going as far as sales expectations as well as earnings. But even on those lower sales this year, we see sales expected 13% lower to 121 million dollars this year. Next year, it is expected to pick up 7.6% growth, back up to about 130 million in sales. We do see negative earnings still over the next couple of years. This is still a very small, very new profitable or very new company that is still building towards that profitability. But even on these lower sales this year, the company is still free cash flow positive, operational cash flow of $20 million. Here we can go into the financials, go into cash flow. Very important, folks, especially for these small penny stocks that you look at this cash flow, you understand how the cash flow is coming into this company. Okay, here we do see operational cash flow still growing very well. 13 million in 2021, 21 million in 2022, slightly lower here, trailing 12 months at 20 million. But that still leaves us with positive free cash flow. Okay, the free cash flow number is from the operating cash flow minus this investing cash flow. Usually it's just minus the capital expenditures within investing cash flow, but here in Yahoo Finance, they've taken out all the investing cash flow. That still gives us a positive free cash flow amount, which is very, very positive for the stock. Operational cash flow 20 million, investing cash flow negative 12 million there. So the company has a fairly good balance sheet as well. After the cash flow, you want to make sure that it has positive free cash flow and usually free cash flow growth. We go to the balance sheet to look at survivability. This is very important for these small penny stock companies because survivability is the key until they get into that growth phase. And so you want to look at here at the total assets within total assets. You look at current assets, you look at cash on the balance sheet. That's the cash they're going to be able to use to pay down debt or to service their current liabilities as well as their current portion of their long-term debt. You want to make sure that they're able to do that to survive over the next couple of years. Again, the company does have a fairly good balance sheet here, $12.3 million in cash against $34 million in total asset or total liabilities, just $22 million in current liabilities. So sales growth is expected to return next year. Shares are trading for a price of just 0.17 times revenue. Okay. So less than 0.2 times revenue. A lot of the weakness here, folks, is just due to that very tough environment for hospitals across the United States. We've seen this in a lot of other hospital and health related companies. If you look at shares of MPW, that healthcare REIT, if you look at a lot of other healthcare companies, hospitals across the US and many service providers are just in the red. They're closing hospitals for unprofitable environment. Or reimbursements from the government for a lot of those services haven't kept up with inflation. They had to put off a lot of these higher margin services during the pandemic. That has weighed on this IT spending for cloud services like CCLD, okay, like Carrot Cloud. But this is still a growth industry. It is a health IT company. I think once we get out of that, or once we evolve from this negative environment for hospitals, they'll go back to spending on upgrading their IT systems, their health information systems. They'll go back to Carrot Cloud, and I think you're going to see a very good turnaround next year or 2025. Giving you the big picture here with that sectorspiders.com, the sector tracker here. Here we are on the 5 days. We do see that just 2 of the 11 stock sectors managed to close higher last week, really with utilities reclaiming their defensive leadership, even in the face of higher interest rates. I pointed out the value in utility stocks in last week's market update, not only on that price to earnings basis. Okay, utility stocks are down, are one of the few sectors down for the year. If we go out here, year to date picture, we see just four sectors down year to date. Utilities, by far the worst performing sector, 10% down. That has brought out the valuations in this sector. But not only that, also for the opportunity to protect your portfolio from a pullback. Okay, we do see that the S&P 500, the broad stock market index, lost 1.33% last week. But if you were in utility stocks, that would have protected a lot of your portfolio from that. You still earn a very good dividend yield from these stocks. Energy stocks were also able to close higher on that surging oil price, but with 5% return over the past month in this oil sector, and oil topping out at about $87, $90 a barrel. I kind of wonder, I hesitate for how far these energy stocks can go. The big economic news for this week will be the Consumer Price Index. That's the CPI report released on Wednesday. Here we are on the Fred economic data, The Federal Reserve Economic Research site Consumer Price Index for all customers, that crucial CPI report, although it is not the inflation measure most closely watched by the Fed, the Federal Reserve likes to watch that PCE report, that is the personal consumption expenditures later on in the month. This one does get more attention, and this one does move the market. Now, August CPI inflation is expected to tip up a little bit to 3.6% over the last year. That would be versus 3.2% pace reported last month. We do see that inflation has come down very quickly from about 9% last year. Come down, it moved up a little bit in June to July to 3.3%. There is, again, it is expected to come up still a little bit more at 3.6% when it's reported here on Wednesday. That core measure, though, which removes volatile food and gasoline prices, is expected to show inflation is still coming down slightly. The August core CPI report is expected at 4.3% versus 4.7% previously. All this is still well above the Fed's 2% annual inflation target, which would mean rates will stay higher for longer, but recent data points do show for a growing slowdown in rent prices. Okay, rents are a third of the CPI inflation data, but really lag other inflationary pressures by 6 months to even a year. That means it takes a while for the slowing rent prices and even declining rent prices to make their way through full inflation and really start bringing it down. Okay, the slowing jobs market that we saw in the jobs report earlier this month, and that lower rent growth is going to be enough to have the Fed pause in their interest rate hikes this month. It's still very much on the table that they might raise rates in November, but I think they're going to see the slowing jobs market. They're going to see inflation continue coming down, and they're going to continue. They're going to continue to hold on their interest rates. That's going to be supportive of stocks. We're going to get economic confirmation of the economic slowdown on Thursday with the report of retail sales. I think all this is going to come together to really show the Fed that interest rates should stop rising and they can eventually start cutting rates, supporting stocks next year. Start building your credit without having to do anything extra with the current app and the link below. Or click on the video to the right for 7 index funds you can use for no stress investing. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.